All right, everybody. Welcome to our Richlawn Apartments overview. This is our first deal of 2025, and we're very excited to present it to you, namely because there has been a ton of market uncertainty and lack of deal flow. So we're happy to announce that we think we got a great asset at a very attractive purchase price in a great submarket of Cleveland. So before we get into the fun of it, just quickly to review the legal disclaimer. As with any investment, there are risks. There are risks in this investment that we outline here. Please read through this in more detail. If you do decide to invest, there will be more risk factors outlined in the PPM and subscription documents that go through all the considerations that you should make when investing in real estate. But now that we got that out of the way, I've heard from a lot of investors, please give me 1 to 2 slides to just tell me what the heck you guys are doing and why this is a great deal. So this slide and the next slide are our best attempt at summarizing that. So the asset's called Richlawn Apartments. It's a 48-unit multifamily property located in Painesville, Ohio. And we'll go into the market overview, Cleveland and Painesville, later on in the slide. But we really like this asset for a number of reasons, but namely it's demonstrated really high historical occupancy for the last 12 months. And this just means we're buying an asset that's in high demand already and very stable. But to increase the demand for the asset, our strategy is to allocate about $6,500 per unit to do cosmetic refreshes of the apartment. And we forecast that we can increase rents over 46% during our first 3 years of ownership. And not only are we going to force appreciation through this capital expenditure plan, but we're also going to focus on decreasing expenses and improving operational efficiency through things like introducing RUBS or ratio utility billing system back to our tenants. And I think most important to investors are how am I going to earn money and what I'm going to get paid. I think one of the unique things about this deal and the way we're positioning it is that after year 3, once we're done with our value add plan, we plan to do a refinance and return 100% of invested capital to investors in year 3. So the idea here is if you invest $100,000 in the deal, we do the refi in year 3, we will return that capital and then some, such that you won't have any principal left in the deal after year 3. Our target IRR is 21%. That effectively means at a high level about you can expect about a 21% average return over the lifetime of the hold period. And our target equity multiple is 2.65, which means if you invest $100,000 into the deal, in aggregate, you'll get about $265,000 back over the lifetime of the deal. And there's a lot that goes into this. If you have any questions on what any of these terms mean, you can click on the link in the deck to get more insight into the definitions of them. So why do we love this deal? I think it goes without stating, but we've already said rents are well below market rent. So this is our bread and butter deal that we do. Light value add operational efficiency plays, and it fits exactly within the types of deals that we like to do. The current owner or seller of the asset, they're not really used to owning and operating these types of deals. Their focus is on car washes that typically have a higher cash on cash return. So they bought this deal, wasn't well capitalized enough to actually implement a value add plan. So they're a little bit stuck in their current positioning. So they want to exit and get back to what they know, which is car washes. But the good thing is, and Jason, one of my partners on the deal, we'll get into this in a bit. His property management company currently manages this asset. That's how he's a partner in the deal. So we'll have no operational risk in transferring property management from one group to another. We'll retain management of this deal once the sale closes. And then again, I can't stress this enough. The refinance potential in year 3, a lot of investors will either complain that our hold periods are too short, meaning 3 years, or too long, meaning 10 years. This is a great kind of hybrid of both in that you get a capital event or return of capital in year 3, and then you get to earn a dividend yield through the following years of ownership. And we'll detail that out in future slides. So a quick overview of who we are. Jason, do you want to give a quick intro?
Sure. everybody. I'm Jason Perro, founded Perro Real Estate in 2001, grown that into one of the largest real estate investment companies in northwestern Pennsylvania. Uh, Served as president, board member of our local landlord and investor association that serviced 1,600 members. And I've owned and managed over 3,000 units. Scaled that back a little bit in the last few years, but um, bring a lot of battle scars and a lot of experience to the table in deals like this.
Hey everyone,
All right.
I'm Dan Charles. I work with Jason primarily on the day-to-day operations of our local assets, focusing primarily on the financial operations. Prior to joining the real estate space, I spent the majority of my time working in mergers and acquisitions at big CEP firms like Deloitte and KPMG, where I helped facilitate over $30 billion worth of transactions. Harrison?
And Harrison Riley, founder of Glass Beach Ventures. My primary focuses are on raising capital, investor relationships, and then the technology stack that supports investment. Spent a lot of time in SaaS and building business operations technology teams and consulting at Accenture. So very much a recovering W-2 employee, and I've been in real estate for about 7 years now. And collectively, our portfolio consists of over 2,000 multifamily units in the Cleveland and Erie area. And, we have significant management and operational experience in this area. So with that, I'll turn it over to Jason to talk a little bit about the property management company.
Sure. So our property management company, brick and mortar property management, currently manage 2,000 rental units in northwestern Pennsylvania, northeastern Ohio. So think the greater Cleveland market and surrounding areas of Erie, Pennsylvania, and we're also in western New York. So take a very focused approach. So we don't do any third-party management, focus solely on properties that I have a key interest and stake in. And we leverage our team's expertise to and experience to do the things that we can control, like maximizing tenant retention, cutting costs, doing things at as bare bones as we can so we can maximize investor returns. We've spent 20 some years now, about 24 years, uh, building out systems, constantly adapting to create a better system and still learning about our market, staying abreast of the latest trends, just trying to maintain the highest standard of excellence for our tenants, you know, providing adequate upkeep of the properties and investing dollars where we can to, make the tenants happy and make our investors happy. And then doing that all at the lowest cost possible. And then, lastly, I mean, we have regional expertise. I mean, not a transaction generally goes on that I'm not aware of in Cleveland and Erie and part of Western New York. So, we tend to see deals well before they would reach the market or when they go stale. Sometimes we pick those up, but just knowing what's going on with different landlords, different property management companies, the trends in terms of, the job market, other economic indicators, things that we can do that our teams that seem to feel like we better relate to our tenants as well as our investors because of that extensive knowledge of our region.
Right. So quickly, we've already touched on a lot of this stuff, but just a quick overview of the property. Again, it's multifamily, which is our core focus, located in Painesville, Ohio. Current occupancy is actually ticked up to 98%. It's a split between 24 one bedroom and 24 two bedroom units, which is a nice desirable mix to have. It's a Class C property, and I have a link to the definitions that show you the difference between Class A, B, and C. We're acquiring it for just over 3 million. Our current in-place rents are about 755 per unit, and we're targeting to move that up to 1,100 per unit. And then our bank loan is just over 2.5 million at a 6.8% interest rate, which is actually great in today's market, and at a loan to cost ratio of 75%. So this means that the bank is actually so confident in the deal that they're helping fund some of the construction or renovation budget as well. So quickly, you'll see some of the before pictures here of what Richlawn looks like. There's also a link that includes even more pictures that I couldn't fit into the slide. And then what these cosmetic refreshes look like after the fact, and some some video walkthroughs that you can see of like properties that we've actually completed recently. So again, this renovation plan target 46% rent increase, and it's not a super heavy lift. So we've seen and demonstrated in the past that we can command high premiums for very simple, quick unit turns. So really straightforward kitchen refreshes like updating of hardware, painting the cabinets, things of that nature. For flooring, not every floor unit is created equal, so we might refinish wood floors if they're there, replace carpet with LVP flooring, which is a little bit more durable and lasts longer. Very minor bathroom updates, and then interior painting goes a long way to really brighten up and refresh the unit. So just to validate that we're in line with the market, we have pretty aggressive rent targets. 46% rent growth is not trivial. But what we wanted to demonstrate was specifically in Painesville and the surrounding area, what do other properties currently command from a 1 or 2 bedroom standpoint? And as you can see, post reno with Richlawn, we're very much in line with market on both 1 and 2 bedrooms, and we might be able to even push the 2 bedroom rent growth even a little bit more because the market clearly seems to be able to demonstrate that. So quickly on the investment summary, this is a 506B offering. You can read in more detail on what a 506B offering is. Essentially, it's not a regulated offering by the SEC and allows us to market and solicit this security or this investment to our existing investor network and allows non-accredited investors to come in and participate, which is important to us because we think anyone who wants to invest in real estate should have the opportunity to. $50,000 minimum investment. We're splitting ownership 50-50 between LPs and GPs. Again, the equity multiple 2.65x, which is very competitive, and we'll show why that's competitive in a bit, as well as the IRR of 21%. A 5% preferred return we're offering. So this just means that LPs earn 5% yield before the general partnership earns any cash flow from operations. Our renovation budget is just shy of $340,000. We're targeting a total equity raise of 1.45 million, and we're holding this deal for 10 years as underwritten. Okay, so this is probably one of the most interesting slides for LPs. What am I actually going to get paid by year and how over the 10-year investment horizon? So what you can see here, because rents are so depressed currently, cash flow is a little bit light in year 1. So if you were to invest $100,000 in year 1, you return about $3,200 from cash flow. And then that steadily increases in year 2 and year 3 as we push rents up to ultimately 46% higher than where they are today. And then this is the point in which once we hit our high watermark rents, we'll refinance and then return 100% of invested capital to investors, as well as some proceeds from that refinance back to investors. So then in my initial review with some investors who have shown interest in this deal, one of the main questions has been, why does it dip so much in year 4? And this is simply just a function of getting a higher loan amount. So more money will be paid to debt service. So cash flow comes back down. But at this point in the deal, you have no money as an investor left in the deal. So your cash on cash return is infinite from this point on. And then in year 10, we plan to sell, at which point we're projecting about $106,000 will be paid back. So all in all, that 2.65x equity multiple can be seen down here with $265,000 in aggregate return. This is a question we get a lot too. How does the GP team make money? And why do some GP teams charge different fees than others? And we wanted to just be overly transparent on what we do and why we've chosen to do it in this way. The only fee that we charge is the concept of an acquisition fee. So this is the fee we pay ourselves upon closing of the deal. And this is for all the work that goes into identifying the deal, analyzing the deal, underwriting the deal, working with lenders to get loans, working with investors to raise capital, all the things that go into securing it and ultimately closing it. We compensate ourselves for that because it's about 3 to 4 months worth of work prior to getting to this point. And that's it. Otherwise, we feel like our interests aren't necessarily aligned with investors. So you'll see these maybe in other deals that you're looking at from other management groups, but these are the other three types of fees typically that management groups or GPs will charge. The first one being an asset management fee, which is typically between a 1 to 2% fee of total equity invested, and this is just paid to the general partnership group regardless of how the property is actually performing. So this is the fee that just gets paid. So we feel that we should get paid commensurate to how the property is actually performing. So we don't charge this fee. And then the other two are specific to what they call a capital transaction fee, and there's two flavors of it. So there's one capital transaction fee that GPs charge for putting together the loan for the refinance event, which we're not charging. We're doing a refinance, but we're not going to charge for doing that work, which is between 0.5 to 1%. And then also a capital transaction fee for selling the deal at the end of the hold period. And we feel like we will get compensated because we've done such a good job in increasing rents, decreasing expenses, and managing the property efficiently, that we'll get paid through the outcome of good management and stewardship of capital versus having to charge fees to get compensated for that. The other thing that investors ask, is this a good deal? Like, how do I even value this? What's the opportunity cost associated to doing this investment versus something else in the market? So what we really wanted to try to do was saying, okay, is this if you're already interested in investing in real estate, you're here looking at this presentation, is this is investing in a Class C value add apartment in Paynesville good relative to other investments in this submarket, similar class, similar strategy. So we compiled a bunch of data to show Richlawn's forecasted returns and structure against the industry range. So you'll see from an IRR perspective, the return that investors should target relative to the risk of this type of investment is between 15 to 20%, whereas we're underwriting a 21% return. So we're above that range. Cash on cash return, the target should be about 8 to 12%. And we're a little bit lower in the first 3 years of ownership because we're buying a property that has such low rents and we're accelerating them so quickly that once we get to the point of refinance, post year 3, your cash on cash return is infinite because you have no money left in the deal. So it's an infinite dividend that you're getting on top of no money into the deal. The equity multiple, we've discussed 2.65x. The expected range is 1.8 to 2.2, so well above that. And then most of these deals last between 4 to 6 years, 5 years typically, to get your capital back or your initial principal. Again, we're planning on doing a refi event and returning capital in year 3. The other thing too, why investors are really interested in real estate investing is for the tax efficient returns. But again, that's kind of a nebulous black box if you're not an accountant. And thankfully we have one in Dan Charles, our partner. So I'm inviting him to talk through some of the tax benefits of real estate investing and what we take, what we do on your behalf so that you don't have to do them.
Thanks, Harrison. So what Harrison had alluded to is part of what makes real estate investing so attractive are the tax advantages, which primarily comes in the form of depreciation. Essentially, the IRS lets us take paper losses against the value of the asset purchased, despite values actually going up. But what really puts gas on the fire is the accelerated depreciation that we're able to take by doing a cost segregation study, essentially breaking down the components of the building into certain useful lives, be it 5 and 15 years, which is eligible for bonus depreciation. With the Tax Cuts and Jobs Act, we had a graduating scale that's been declining. As you can see in the slide here, we're able to deduct up to 40% of the improvement value in year 1. Next slide. So as you can see from the breakdown below, you can reasonably expect a 19% of your invested capital to show up as a loss in year 1 based on a mix of accelerated depreciation and expected CapEx spend in year 1. However, please note that this is a high-level estimate. That said, this information shouldn't necessarily be relied upon until you receive your K-1 next year. More importantly, I always suggest that you confer with your tax advisor regarding your ability to utilize these losses, as everyone's tax picture truly is unique. Next slide.
And so Dan, so said in kind of like non-accounting speak, if you invested $100,000, you could expect a $19,000 loss to be on your K1. But again, subject to what the actual K1 will yield, and then obviously talk to your CPA regarding how you can take advantage of that loss.
Next slide. All right, let's talk about sources and uses. So for this deal, we were able to secure north of $2.5 million of debt financing, with the remainder coming from investor equity. We then plan on using the little south of $4 million of capital toward the property acquisition, renovation costs, closing costs, reserves, and Harrison had mentioned earlier, the acquisition fee paid to the sponsor team. Next slide.
All right, Jason, I'm going to turn it over to you. So we're going to walk through the Cleveland market, the Painesville market, and some of the economic indicators of why we're bullish on the Cleveland area and why we think it's a good area to invest in real estate.
Sure. Thank you. So a little bit about Cleveland, Ohio. It is the second largest city in Ohio, and it's 390,000 residents within the city, but a little north of 2 million in the metropolitan area. And then there's surrounding areas like Painesville that most people outside of Cleveland would consider Cleveland, but it's not part of the greater market. A lot of people live in Painesville and commute to downtown Cleveland for work or surrounding areas. Very affordable as it relates to like national housing prices. So the median housing prices are still 30 to 40% below national averages. And it's a great quality of life. You have major sports teams, parks, art, all major concerts. I mean, always something to do in Cleveland. And I think, being able to get the feel of a big city, but at affordable small market prices. It is a diverse economy. The big anchor there is the Cleveland Clinic. Cleveland Clinic is not going anywhere. It's been consistently ranked as one of the top hospital and healthcare systems in the country. Top cardiac program in the country. I don't know, like 2 decades and counting. A lot of specialty manufacturing, tech firms, and then along with education like Case Western, that's a very well known law school as well as medical school. And with all of that, there's just a huge rental demand. There's a lot of people that live in, want to live in this city, near the city, but have an affordable cost of living, and being able to take advantage of all of the positive things that the Cleveland area has to offer. So Painesville, Ohio, it's about 30 miles from downtown Cleveland. The property is a few minutes off the highway. It's easy to get to. It's a beautiful setting. So in that small town, there's a lot of, think, mom and pop diners and small restaurants, and like they still do parades, and anytime there's St. Patty's Day and 4th of July and all these kind of family friendly things. So people choose to live in a small town like Painesville. It's near Lake Erie College and Tri Point Medical Center. So these kind of like smaller kind of educational things within the healthcare industry. Very, very safe area. It's had a small but steady annual growth in that area. We've seen a lot of people move from the cities to these surrounding suburbs, and again, the price per door, the price per pound that we're paying in a market like this is still far less than what we're getting in the hotter downtown area of Cleveland. And again, very close to the lake. Lake Erie, believe it or not, has one of the best sunsets in the country, and it's just sort of a kind of a hidden gem. So people love being close to the lake, close to the parks. A lot of outdoor things to do. And so again, healthcare is really the predominant employment landscape in Cleveland. I mean, Cleveland Clinic being the largest employer, there's also university hospitals, and there's so much, even with technology, that goes into and around, that's built around the medical community, the healthcare community. So when we talk about technology, it's healthcare technology. There's a lot of manufacturing. They're manufacturing medical devices and medical supplies. So a lot of things tied into healthcare, and we have a aging population. healthcare seems to be one of the most stable industries in our economy. But there's also education, with a lot of universities, and also government work. So it's a really stable economy in Cleveland. And there's a lot of ups and downs, and even in 2008, the losses and this market crash in 2008 didn't affect Cleveland the same way it affected areas like Florida and California and other areas. So really strong fundamentally or fundamentals in the economy there. I mean, it's a slow but steady annual growth rate. Unemployment always seems to be below the national average, even in these times like 2008, when COVID hit and there was this, weird economy we were dealing with. Cleveland tends to fall below the national average as it relates to unemployment, but tends to always have a slow but steady upward trend for the economy. 8 major universities, so that's 15,000 graduates a year. There's a lot of those graduates that come to us looking for, an affordable place to live, and it's kind of that step between graduating medical school, or law school, regular undergrad, and then the next step, getting their first job or saving up to buy their first home, starting to pay off their student loans and getting their feet beneath them. So that's definitely a good portion of our target rental demographic. Property values have been steadily increasing over the last 5 years, and rental rates have also increased. We've not seen a huge bump like we've seen in other markets, but it's just been a nice steady year-over-year growth. And again, I can't beat this drum enough, but the security with the employment within the healthcare industry. So I would say, huge percentage of our residents work in the healthcare sector. If it's not, medical residents or new doctors, it's going to be somebody going through nursing school, or they work as a nurse or a medical technician or something like that. So all of these types of jobs pay better than the average job. Healthcare tends to pay, provide a really good income for the people that work within it. So we feel really great about our target demographic for all of the properties that we own and manage.
Great, awesome. Thanks, Jason. So then what's next? The opportunity is going to be open in the investor portal for reservations on the 8th. You'll have ample time as we put together all the offering materials and subscription documents to review that. And we ask that you sign them by 5/29. We request that the money be funded by early June, so the 2nd of June, and with the target closing date of mid-June. This target closing date's very much subject to change based on how some of these transactions have gone historically, but this is the current time frame, and we will make sure to communicate any changes to you as they arise. And then again, if you have any questions in this deck, you can shoot me an email, give me a call, book some time on my calendar, and happy to review anything. But again, thanks everybody for your time. And we look forward to partnering with you on what we think is a awesome deal. All right, thanks all.